Welcome to today's deep dive into the mechanics of credit default swaps, or CDs, which essentially act as an insurance policy against a company's default. In a standard CDs contract, the protection buyer seeks to hedge against credit risk by making regular fixed quarterly payments, known as the CDs spread, to the protection seller. The company being insured is referred to as the reference entity. If this firm experiences a credit event, such as a failure to pay, debt restructuring, or bankruptcy, the seller is obligated to compensate the buyer. To illustrate this with real numbers, imagine an advisor named Fia owns $200 million in bonds issued by Elf Corp. To protect this position, Fia buys a CDs from a market maker at a spread of 75 basis points. This means Fia pays an annual premium of $1.5 million, which is calculated as 200 million multiplied by 0.0075. This breaks down to $375,000 every quarter on standard maturity dates like March 20th and June 20th. Now, if Elf Corp stays healthy, Fia receives nothing and simply continues paying the premium for the 5-year life of the swap. However, if a default occurs, the contract is settled. In a physical settlement, the seller pays the buyer the full $200 million par value and receives the defaulted bonds in exchange. Because a company may have several different bonds outstanding, the buyer will typically deliver the cheapest to deliver bond to maximize their position. In a cash settlement, the payout is based on the difference between the face value and the market price of that cheapest to deliver bond. For example, if the bond is valued at 40 cents on the dollar, the cash payoff to the buyer would be 60%, or $120 million. It is also important to note that if a default happens between payment dates, the buyer must make one final accrual payment to cover the time since the last payment before the premiums cease. Moving beyond individual companies, we have credit indices like the CDX in North America and the iTraxx in Europe, which allow investors to buy or sell protection on a basket of 125 different entities. For a 5-year iTraxx index quoted at an ask price of 152 basis points, an investor seeking €500,000 of protection per firm would pay a total annual premium of €950,000. If one of those 125 firms defaults, the investor receives a payout for that specific firm, and the future annual payments are reduced by 1/125th, or €7,600. Finally, in the modern market, these contracts often use standardized coupons, typically 100 basis points for investment-grade issuers. Since this fixed coupon rarely matches the actual market CD spread, an upfront premium is paid at the start of the contract to bridge the gap. If the market spread is higher than the 1% coupon, the protection buyer pays the present value of that difference to the seller. If the market spread is lower than the coupon, the seller actually pays the buyer. This standardization makes the clearing and trading of CDs contracts much more efficient across the global financial markets.